Barbara retired at 63. 28 years as a nurse in the NHS, a defined contribution pension pot worth £310,000, and a small final salary top-up from an old employer. Her financial advisor told her the same thing he tells every client: don't touch the pension, live off your ISA and your savings first. Let the pension keep growing tax-free. Leave it for the kids if you don't need it. So that's exactly what Barbara did. For years, that was genuinely excellent advice, because under the current rules, a pension pot sitting untouched when you die passes to your children completely free of inheritance tax. Your ISA doesn't get that treatment, your savings account doesn't get that treatment, but your pension does. So advisors across the country have spent a decade telling clients the same thing: spend everything else first, protect the pension. It's the most tax-efficient thing you own. Then, on the 18th of March, 2026, that advice quietly became out of date, because on that date, the Finance Act 2026 received royal assent, and buried inside it is a change that will affect hundreds of thousands of retirement plans across this country. From the 6th of April, 2027, unused pension funds and pension death benefits will, for the first time in modern history, be counted as part of your estate for inheritance tax. Barbara doesn't know this yet. Her advisor gave her that instruction years ago and has never called to update it. If she dies after April 2027 with that pension still largely untouched, her children could face a tax bill on money that right now would have passed to them completely free. This video is for educational purposes only and is not financial, tax, or legal advice. Everyone's situation is different, and you should speak to a qualified, regulated financial advisor before making any decisions about your pension or your estate. This is Retired UK. Every week I break down the pension rules, the tax traps, and the strategies that protect retirees from the things nobody else is explaining clearly. If that's useful to you, hit subscribe and turn on notifications, because this channel exists to keep you ahead of changes like the one I'm about to walk you through. Today, I'm going to explain exactly what this pension inheritance tax change is, why the window to plan around it closes for good in April 2027, and the 3 situations where retirees are most exposed right now without realizing it. Let's start with how things work today, right now, while I'm recording this in August 2026. At the moment, most defined contribution pensions in the UK cite outside your estate for inheritance tax purposes. That's because most schemes are set up on a discretionary basis. The scheme trustees, not your will, decide who receives the money when you die, guided by the nomination form you filled in. Because it's discretionary, HMRC has traditionally treated it as outside your estate entirely. No inheritance tax. If you die before 75, your beneficiaries can usually take that pension completely free of income tax too. If you die after 75, they pay income tax on withdrawals at their own rate, but still no inheritance tax. This is precisely why pensions became the single most popular estate planning tool in Britain over the last decade. Advisors routinely told clients to draw down their ISAs, their savings, their other investments first, and preserve the pension for as long as possible, because everything else in your estate is exposed to 40% inheritance tax above your allowances, and the pension isn't. From the 6th of April 2027, that changes. Unused pension funds and most death benefits will be pulled into the value of your estate. If your total estate, including that pension, exceeds your available nil rate band, currently £325,000, plus your residence nil rate band of up to £175,000 if you're leaving a home to children or grandchildren, the excess is taxed at 40%. Here's the part that makes this genuinely dangerous, and it's the part almost nobody explains properly. If your pension goes to someone other than your spouse or civil partner and you die after age 75, that money could now face both income tax on the way out to your beneficiary and inheritance tax on the way into their estate calculation on the same pot of money. In some cases, that combined effective rate can climb past 60%. Two different taxes stacked on top of each other on money you spent decades building up. The government itself estimates that around 10,500 additional estates a year will become liable for inheritance tax purely because of this change that weren't liable before. If you've built a meaningful pension pot and you're planning to leave some of it behind, there's a real chance you're now in that group and you haven't been told. Let me show you 3 people and 3 very different levels of exposure to this window closing. David is 67, retired from a logistics firm in Leeds. He's married, has 2 adult children, and a pension pot worth £280,000. Here's David's situation, and it's the one piece of good news in this entire video. If David dies and leaves everything to his wife, none of this matters. The spousal exemption's still in full. Transfers between spouses and civil partners remain completely free of inheritance tax, pension included. David doesn't need to panic, but David's wife does need a plan, because when she eventually passes the estate onto their children, that pension will now be inside the calculation, and by then, it may have grown considerably larger. Angela is 71, widowed, retired teacher from Cardiff. Her estate is worth just over £1 million once you include her house, her savings, her ISA, and a pension pot of £400,000 that she has barely touched. Angela has no spouse to leave things to. Her plan is to split everything between her 2 children. Under the current rules, that pension passes to them free of inheritance tax. Under the rules from April 2027 onward, that £400,000 gets added straight into her estate and a large chunk of it crosses into the 40% band. Angela is exactly the kind of person this change was designed to catch, and she has no idea it's coming. Michael is 64, still working part-time, self-employed, from Bristol. His pension is worth £190,000 and his total estate, including his house, is under £600,000 because Michael is married and plans to leave the family home to his children, eventually using both his and his wife's nil-rate bands and residents' nil-rate bands. Most of his estate may never cross the taxable threshold at all, even after 2027. Michael doesn't need drastic action. He needs an accurate estate valuation so he knows for certain which category he's actually in instead of guessing. Here's what David, Angela and Michael all have in common. None of them have had their estate plan reviewed since this legislation passed, and the advice their advisors gave them years ago, spend everything else first, preserve the pension, may now be precisely backwards for some of them. Now let me walk you through the 3 things that catch retirees out most often once this change lands. Trap number 1. The spending order that used to be smart advice becomes a liability. For a decade, the standard guidance was ISA and savings first, pension last, because the pension was shielded from inheritance tax and everything else wasn't. From April 2027, that shield disappears for anyone leaving pension money to someone other than a spouse. If you keep following that old instruction after the rules change, you could end up preserving the exact asset that's now fully taxable while running down assets that were never going to be taxed as heavily in the first place. The spending order needs re-examining, not assumed. Trap number 2. The double taxation trap for beneficiaries who inherit after you turn 75. If you die after 75 and leave pension money to your children, they already pay income tax on what they withdraw at their own marginal rate. From 2027, that same pot may also be included in your estate's inheritance tax calculation before it even reaches them. 2 taxes, 2 different systems, both applying to the same money. Families who don't plan for this could see a much smaller inheritance arrive than the headline pot value suggested. Trap number 3. The nil-rate band squeeze. Your nil rate band and residence nil rate band haven't grown to reflect the fact that your pension is about to be added into the total. If your estate was previously comfortably under the threshold without the pension counted, adding a £2, £3 or £400,000 pension into that calculation can push you straight past it. Sometimes without you realizing until it's far too late to plan around it. Estates that felt completely safe under the old rules may not be safe at all under the new ones. Here's what I need you to understand about these three traps. This isn't HMRC trying to catch you out with something obscure. This is a fundamental, publicly announced restructuring of how pensions are treated on death, and the transition period is short. Legislation was confirmed in March 2026. It takes effect in April 2027. That gives every retiree in this country roughly 20 months from the point this law was confirmed to actually review their plan, and a large number of people haven't started. So here is your action checklist. 6 steps, and I'd start this month, not next year. Step 1, get an accurate current valuation of your entire estate. That means your home, your savings, your ISAs, your investments, and yes, your pension pots, all added together. Most people have never actually done this sum. Without it, you cannot know whether this change affects you at all. Step 2, check your nil rate band and residence nil rate band position. £325,000 standard nil rate band up to £175,000 residence nil rate band if you're leaving a home to direct descendants. Married couples can typically combine both partners' allowances, potentially shielding up to £1 million between them. Know your actual number, not a rough guess. Step 3, review your pension nomination form, sometimes called an expression of wish. This tells your pension provider who you want the money to go to. It is often years out of date. Circumstances change, relationships change, and an outdated nomination can create complications on top of the tax question. Step 4, reconsider your spending order with a professional. If a large share of your wealth is inside a pension and you're planning to leave money to children rather than a spouse, it may now make sense to draw down more from the pension during your lifetime rather than preserving it as untouched as possible. This depends entirely on your personal numbers, so this is not something to guess at alone. Step 5. Understand your gifting allowances. You can currently give away £3,000 a year completely free of inheritance tax considerations, and larger gifts can become fully exempt if you survive 7 years from the date you make them. For some people, using pension withdrawals to make structured gifts now, while the rules and the clock are both in your favour, is part of a sensible plan. This is highly individual and needs proper advice, not a rule of thumb from a video. Step 6. Speak to a regulated financial advisor who has specifically reviewed the Finance Act 2026 pension changes, not someone repeating advice they gave you 5 years ago. Ask them directly how the April 2027 change affects your specific estate, your specific beneficiaries, and your specific pension structure. If they can't answer that clearly, it's worth getting a second opinion before the window closes. Barbara, the nurse from the start of this video, still has time. It's August 2026 as I'm recording this. The rules haven't changed yet. Her pension is still right now outside her estate for inheritance tax. But the clock started the moment that legislation received royal assent, and it runs out on the 6th of April 2027. After that date, the advice she was given years ago, the advice that was completely correct at the time, could end up costing her children a substantial and entirely avoidable tax bill. You are not Barbara yet. You still have time to get an accurate valuation, review your nomination forms, and have a proper conversation with a regulated advisor about whether your current plan still makes sense under the new rules. But that window is measured in months now, not years. This is Retired UK. If this video helped you understand something your advisor hasn't explained to you yet, hit like, subscribe, and turn on the bell so you don't miss the next one. And share this with anyone you know who has a meaningful pension pot and is planning to leave some of it behind because they need to see this before April 2027, not after. Let me know in the comments, has your advisor already mentioned this change to you, or is this the first you're hearing of it? I read every comment, and the most common questions become future videos.